The bond market doesn't a T usually shout. It doesn't T have to. It just leans. And when it leans hard enough, everything else eventually tilts with it. Right now, that lean is showing up in a very specific place. Rates are losing upside momentum, and macro money is rotating into metals the way it tends to do when the cost of money starts coming down and real yields stop acting like gravity. This is about a regime shift in how capital is being priced. When rates turn lower, the entire incentive structure across portfolios changes. Cash stops feeling like a trophy. Short duration stops dominating. The dollar often loses its clean advantage. And assets that don a T pay yield, like gold and silver, suddenly stop looking unproductive and start looking like a form of optionality. Start with the numbers, because feelings don't move markets. Flows do. According to the St. 24% on January 27th, 2026. That's the benchmark rate that quietly influences everything from corporate borrowing costs to the discount rate used in equity valuations. 90% real, and both matter. Repeat that. The real yield was still meaningfully positive. That means the market was paying a real return to hold inflation-protected duration. In most cycles, real yields being that high creates a headwind for gold. And yet gold has been ripping anyway. That contradiction is the signal. When gold rallies in the face of positive real yields, something bigger is being priced than a simple rates down, gold up trade. Now layer in the metals tape. Gold's spot price has been trading in the mid-5,000s. One widely tracked retail quote source, JM Bullion, showed gold around $5,300 at $67 per ounce on January 29th, 2026, 15 on January 29th. That's not a gentle drift, that's a step change. Silver has been even more explosive. 44 on January 28th. In plain language, silver went from the low 70s at the start of January to well over $100 before. Most people finished updating their mental model of what normal silver looks like. Let that sink in. Moves like that don't happen in a vacuum. They happen when positioning, macro expectations, and physical fundamentals all start pulling in the same direction. So what does macro flows rotate into metals actually mean? It means large pools of capital are reallocating, not because of a single headline, but because their frameworks are responding to the direction of rates, the path of policy expectations, and the shape of risk. And those reallocations show up first in the most liquid instruments, futures, ETFs, and options, before they show up in mainstream narratives. Think about how the biggest players behave. Pension funds, insurers, sovereign wealth, large RIAs, systematic trend funds, risk parity strategies. They don't wake up and decide to feel bullish. They run constraints and models. They respond to volatility. They respond to correlations. They respond to the expected return of holding cash versus holding duration versus holding inflation hedges. When rates are rising, cash has a glow. Money market yields look attractive. Short duration looks safe. The dollar often benefits. That environment can suppress metals longer than people expect, even if the long-term macro story is building. But when rates crest, and the market starts to believe the next major move is down, those same models begin to shift. Duration stops being a guaranteed drag. The dollar's tailwind can fade. The opportunity cost of holding non-yielding assets drops. And that when gold and silver start getting treated less like a niche trade and more like a portfolio component, here's where it gets really interesting. Lower rates don't arrive for one reason. They usually arrive because something is slowing, something is breaking, or policy is bending. And those are three different scenarios. If rates fall because inflation collapses faster than yields fall, real yields can rise. That's the deflationary scare scenario, the one where cash can outperform and metals can chop or even drop in the short term. If rates fall because growth is weakening and the market starts pricing cuts, real yields can fall, especially if inflation expectations don't collapse at the same pace. That scenario is historically supportive for gold. If rates fall because the system can't tolerate the debt service burden at high rates and policy is pressured to keep financing conditions looser, that's a different kind of story. That's the one where nominal stability gets prioritized, inflation expectations can stay sticky, and confidence hedges like gold can behave like insurance. Now ask a simple question. Which of these movies looks most plausible when gold and silver are behaving like this while real yields are still positive? That's the tell. It's pricing uncertainty about policy credibility, fiscal constraints, and the stability of the unit of account over time. Now zoom into market structure, because metals are not just shiny rocks. Metals are a global pricing system. Futures exchanges, over-the-counter wholesale markets, ETFs, options, and physical premiums, all stitched together by arbitrage and confidence. COMEX, the US futures exchange, is where a massive amount of price discovery happens. When flows hit, they hit there first because it's liquid and levered. According to an Associated Press market report on January 29, 2026, COMEX gold futures posted an estimated trading volume of about 656 contracts, with open interest around 488,001. Volume that big tells a story. Participation is intense. Open interest shifting tells another story. Positions are being opened, closed, rolled, and managed aggressively. That's what a macro rotation looks like when it's happening in real time. And when participation expands like that, price can move fast because leverage compresses time. In other words, what might have taken months in a slow physical market can happen in days through derivatives. Now connect this to the real economy channel because rates aren't abstract. Mortgage rates are one of the cleanest Main Street expressions of the bond market. 95% a year earlier. That's what rates turning lower looks like for households. Not as a chart, but as monthly payment math. And when financing costs ease, the economy responds, sometimes slowly, sometimes unevenly, but the direction matters. Easier financial conditions can support activity, but they can also signal that policy is reacting to weakness. Either way, the market reprices expectations. And that repricing is exactly what macro flows front run. Now bring in the historical rhyme, because metals love turning points. In 1979 to 1980, the world learned what happens when inflation expectations and confidence collide. Gold went vertical, then volatility became brutal. That period is extreme and not a copy-paste template, but it teaches one timeless lesson. Once the public starts questioning the stability of money itself, markets can reprice faster than most models allow. In the early 2000s into 2011, gold rode a long wave as real yields and policy credibility shifted through multiple crises. In March 2020, gold initially sold off with everything else during the liquidity scramble, then rebounded hard as policy response arrived and real yields compressed. That pattern matters because it highlights a key risk that trips people up. During liquidity stress, metals can drop even if the thesis is bullish because margin calls don't care about narratives. Forced selling is forced selling. But once the forced selling passes, and the market focuses again on policy response and real yield direction, metals often reassert the trend. That's why analysis needs two time frames at once: short-term liquidity risk and longer-term regime shift. Now, gold is the clean macro metal, silver is the messy one, and silver's messiness is exactly why it can move like a rocket. Silver sits at the intersection of monetary psychology and industrial reality. It's an investment asset, and it's a critical input for electronics, solar, automotive systems, and advanced manufacturing. That dual identity makes silver uniquely sensitive when macro money decides to show up while industrial demand is already pulling. 9 million ounces in 2024, 5 million ounces, 7 million ounces, 16 billion ounces. Those numbers tell a simple story. The market has been tight enough that above-ground stocks have been doing the buffering. And when buffers get thin, price becomes the rationing mechanism. That's when moves become violent. Not because someone flips a switch, but because the system has less slack. Here's what you need to understand. Supply doesn't respond quickly. Mines take years. Permitting takes years. Refining capacity isn't built overnight. Meanwhile, demand can spike in a quarter if policy expectations shift or if investment flows accelerate. That's the structural setup that makes silver's upside tails fat, and its downside snaps sharp. It's a market that can lull participants to sleep and punish them for underestimating how quickly it can reprice. Now, the technical layer matters, because flows express themselves through levels, not essays. With gold trading above $5,000, round numbers become battlegrounds. $5,000 is not magical because of physics. It's magical because humans and risk systems care about it. Above that, prior highs are the obvious friction zones. 4. That puts a clear reference zone on the chart, the kind of area where profit-taking, hedging, and volatility often spike. For silver, the reference points are even sharper. $100 is psychological. The high around $118 to $120 becomes a near-term ceiling to watch. 44 before pulling back sharply. It means volatility regime. It means positioning is heavy and liquidity pockets are thinner. But overbought is not a sell signal by itself in a strong trend. It's a warning that pullbacks can be sudden. The cleaner red is how price behaves after the pullback. Does it reclaim key levels quickly? Or does it grind lower and fail? The moving averages matter too, especially the 50-day and 200-day. In strong uptrends, the 50-day tends to stay above the 200-day, and pullbacks often find buyers near those trend guides. When that relationship breaks, the market is telling a different story. Not a guaranteed story, but a story worth respecting. Now, the bearish case needs to be real because metals can humble anyone. The bearish case starts with real yields. If inflation expectations fall faster than nominal yields, real yields can stay high or rise. That would restore opportunity cost pressure on gold and silver. The bearish case includes the dollar. If global stress spikes and capital runs into dollars as a clean shirt in a dirty laundry basket, metals can stall or pull back, even if the longer-term story remains supportive. The bearish case includes liquidity events. In a true risk-off liquidation, everything gets sold to raise cash. That can include gold and silver, at least temporarily. The bearish case includes policy intervention risk. Futures markets can see margin requirement increases that force leveraged participants to de-risk quickly. Regulations can shift, positioning can unwind faster than expected, and the bearish case includes crowding. When a trade becomes popular, late entrants get punished, pullbacks become sharper, headlines turn euphoric right before the market tests conviction. So, yes, reversals can happen, chop can happen, sharp drawdowns can happen. Time will tell whether the current move is a straight line, and straight lines are rare. But here's what those risks don't change. The macro logic of a rate regime shift. When rates are turning lower and the market is pricing a different path for policy, the relative attractiveness of metals improves. Not because metals are perfect, but because their role becomes more valuable when uncertainty rises and when real returns on safe assets compress. Gold is the confidence hedge. Silver is the confidence hedge plus industrial tightness. That combination can be powerful and unstable at the same time. Track real yields. The 10-year TIPS yield is a clean proxy. When it's rising, metals often fight gravity. When it's rolling over, metals often find air. Track the nominal 10-year. Watch the trend, not the tick. A steady drift lower is different from chaotic spikes. Track the mortgage rate channel as a real-world confirmation that financial conditions are easing. 1% is a meaningful downshift from the prior year. Track how metals behave on pullbacks. In a healthy rotation, dips get bought. Not instantly every time, but consistently enough that higher lows form. Track whether the move is broadening. A real macro rotation often shows up not only in spot prices, but in futures participation, ETF flows, and options activity. Now, audience implications. Because different time frames are different games. For short-term traders, the primary enemy is volatility. That means position sizing matters, stops matter, respect for levels matters. A correct thesis with bad risk management still ends badly. For longer-term investors, the primary question is allocation and discipline. Metals are not a promise. They're a hedge and an optionality instrument. The point is not to predict the next tick. The point is to avoid being forced into decisions when the macro environment shifts. For physical holders, the primary risk is emotional timing. Buying into euphoria and then getting shaken out on a drawdown is the classic cycle. A steadier approach is pacing, patience, and remembering why the exposure exists in the first place. For newcomers, the most important move is education. Know the plumbing. COMEX is futures. LBMA is a core wholesale market hub. Spot is immediate price. Futures are contracts. Backwardation and contango describe the shape of futures curves and can hint at tightness or carry dynamics. Premiums can diverge from spot when physical supply chains tighten. Those details matter because the story can look calm on a chart while stress is building underneath in inventories and delivery dynamics. Now, verification, no shortcuts. Fred provides the benchmark yield data. The World Gold Council publishes demand and flow research through its gold demand trends reports. The Silver Institute's World Silver Survey provides the best consolidated annual view of silver supply and demand, produced by Metals Focus. Associated Press market reports provide snapshots of futures participation and mortgage rate benchmarks. Those sources are not perfect, but they are concrete places to check claims rather than relying on noise. And don't forget the simplest discipline. Separate fact from interpretation. 24% on January 27th, 2026 per Fred. 90% on the same day per Fred. Fact is, gold and silver were trading in historically elevated territory in late January 2026, with spot gold around the mid-5,000s and silver around the mid-100s, depending on timestamp, 5 million ounces. 1% were reported by Freddie Mac's weekly average through AP coverage. Those are anchors. Interpretation is what it means next. This could extend. This could mean the market is repricing policy credibility and fiscal constraints. This could mean inflation expectations are not as anchored as assumed. This could mean investors are rebuilding hedges after years of being underweight real assets. Or this could mean a crowded trade is about to shake out before continuing. That uncertainty is precisely why metals can matter in a portfolio context, because they tend to perform when certainty breaks down. Now a full risk disclosure, because this has to be said clearly. Metals are volatile. Silver in particular can swing hard, up and down fast. Liquidity events can cause drawdowns even when the long-term thesis remains intact. No one can guarantee outcomes. Nothing here is financial advice. Any decision should be based on personal circumstances, independent verification, and risk tolerance. Overexposure and leverage are where good ideas turn into bad outcomes. And now the strategic close, the part that lands the core message without hype. The key signal isn't T that gold is high. It's S that gold is behaving like a confidence hedge while the bond market is leaning toward lower rates. The key signal isn't T that silver is volatile. S that silver is volatile in a way that often appears when tight fundamentals meet accelerating macro flows. The key signal isn't TA headline. It's the incentive structure changing underneath the system. When rates turn lower, capital doesn't ask permission to rotate. It just rotates, quietly at first and then all at once. And if the bond market S lean continues, the real question isn't T whether metals can move from here. It's whether that rotation is recognized while it still looks like noise, instead of waiting until it looks like inevitability.